Okay, let's jump in. Forget trying to predict the market's next big swing. Imagine instead an investment strategy built to handle, well, basically any economic storm. Growth, recession, inflation, deflation. It's not based on a forecast. It's based on being prepared. We're talking about Ray Dalio's all-weather portfolio. It's got quite a reputation. Welcome to the deep dive.
Today, our mission is to really peel back the layers here. Using the sources you've given us, we want to understand the thinking, the structure, the performance, everything. It's more than just the allocation percentages, right? It's about the philosophy underneath.
That's exactly right. We've got this stack of articles, research notes. That's our guide for this exploration. We're aiming to get to the heart of what Dalio was really trying to build. You know, how he tried to create something resilient enough for, well, anything the economy throws at it.
Great. So where does this all-weather story really begin? Well, the portfolio itself was formally put together by Ray Dalio and Bridgewater Associates back in 1996. But his thinking, it was shaped much earlier. He often points to big macroeconomic shifts. A key one was the U.S. dollar leaving the Bretton Woods system in 1971.
Okay, Bretton Woods. Why was that specific event so important? For someone maybe familiar with finance but not a deep historian, what was it and why did its collapse matter for this strategy?
Yeah, good question. So, very briefly, Bretton Woods was set up after World War II. It basically pegged global currencies to the U.S. dollar, and the dollar itself was convertible to gold, fixed price. It led to a pretty stable currency environment for a while. But when the U.S. stopped letting dollars be converted to gold in 71, that fundamentally changed everything. We moved to floating exchange rates, left more volatility, much more unpredictability around inflation, currency values. For Dalio, it was a huge lesson. Fundamental shifts happen unexpectedly. You need a strategy that can survive those, not just one that works when things are calm and stable.
So it wasn't just about optimizing for smooth sailing. It was built knowing massive, unforeseen storms could hit.
Exactly. It came from seeing how vulnerable traditional portfolios are. You know, the ones heavily loaded with stocks. They get hammered in these big shifts or downturns.
Right. And Dalio's answer to this uncertainty was to define these four economic seasons, you could call them, these environments that drive asset prices. Can you walk us through those?
Sure. His research basically boiled it down to four states. It depends on whether economic growth and inflation are coming in higher or lower than what people expect. So, number one, periods where growth is stronger than expected. Let's call that rising growth. Two, times when growth is weaker than expected. Falling growth, maybe heading into recession. Three, environments where inflation is higher than expected, rising inflation.
Yeah.
And four, periods of lower than expected inflation, maybe even deflation, falling inflation.
Okay, those four kinds of weather. So what's the goal of the all-weather portfolio then? Is it trying to knock it out of the park in every single one?
No, not at all. That's explicitly not the goal. The aim is much more modest in a way. It's to perform reasonably well across all of them. The idea is to, quote, weather through any financial climate, keep investors in the market, earning returns, but always prepared for the unexpected. Consistency over home runs.
Which really ties back to what you said about intellectual humility. If you admit you can't reliably guess which season is next,
Right.
then building your whole plan on getting that guess right seems fragile. The thinking shifts. It's not what's going to happen, it's how do I prepare for whatever happens.
That's the core philosophical change. It's built on this belief from watching markets for ages that no one asset class stays on top forever. And the big one, the future is uncertain. So the portfolio has to be tough enough to handle lots of different outcomes without needing any single prediction to be right.
And this leads us right to the concept that makes all weather really different. Risk parity. How does that compare to how most people think about building a portfolio?
Yeah, this is really the key idea. See, traditional thinking focuses on allocating capital. So, okay, 60% of my money in stocks, 40% in bonds. Simple enough. But here's the thing. Stocks are way more volatile than bonds. So that 60% of your capital might actually be driving 90%, maybe even more, of your portfolio's risk. Risk parity flips that. It focuses on allocating risk. The goal is to balance out the contribution to the portfolio's overall risk from different assets, or more precisely, from assets that do well in those four different economic environments we talked about.
So it's less about where's my money and more about where's my risk coming from. You want roughly equal risk exposure to each of those four economic seasons.
Precisely. Equalizing the risk contribution.
Right.
So whether we get rising growth, rising inflation, or falling inflation, no single environment completely blows up your portfolio. It's diversification of risk exposures. That's the paradigm shift.
Fascinating stuff. Okay, so how do you actually build this? I know the institutional version Dalio runs is super complex, but there's this blueprint people talk about, sometimes called the Tony Robbins version, that gives us the basic mechanics, right?
Yes, exactly. That blueprint, which is based on Dalio's public explanations, is a really useful way to grasp the mechanics. It tries to allocate capital using everyday assets to approximate that risk balance across the four regimes.
All right, let's break that down based on the sources. Can you walk us through the pieces, the typical weights in that blueprint, and what each one is supposed to do?
Sure thing. And the allocation itself might look a bit strange if you're used to standard portfolios. It starts with a really big slice in long-term treasury bonds, typically around 40%, their job. Stability, cushioning the blows during downturns. Especially when growth is falling or deflation hits. When growth tanks and rates fall, these bonds tend to do well.
40%. Wow. Okay, what else?
Next up, intermediate-term treasury bonds, about 15%. They also offer stability, income, but they're less sensitive to rate changes than the long bonds. Good in disinflation or milder recessions.
So that's 55% in bonds already.
Yep. Then you have equities, stocks at around 30%. That's your growth component. Does well when the economy's booming, rising growth. Often okay during disinflation too.
Only 30% stocks. Okay.
Then for inflation protection, you've got gold, usually 7.5%. Gold's seen as that store of value. Tends to shine when inflation climbs, currencies wobble, or there's major market stress. A crisis hedge.
And the Leskies.
Commodities, also 7.5%. Things like oil, metals, agriculture, they benefit when raw material prices go up. So good in rising inflation and often do well early in the growth cycle too.
So you look at that, 55% bonds, only 30% stocks. That feels really, really different. What does that allocation scream about the strategy's main goal?
It screams defense. It's fundamentally a defensive posture. That high bond, low equity mix, it clearly prioritizes preserving capital and smoothing out the ride over chasing maximum growth in bull markets. You're consciously trading away some potential upside when stocks are flying for much smaller losses when things go south. The sources say it's about getting wealthy slowly but steadily, protecting one's capital.
And the reason for these specific percentages goes back to that risk parity idea. Balancing the risk from the four seasons.
Exactly. That's the driving logic. The goal is to have assets that thrive in each of those four environments and balance their risk contributions. Dalio talks about relying on cause and effect relationships, not just unstable correlations. His point is, correlations between assets can break down right when you need them most. But the fundamental reasons why assets perform in certain economic conditions, those are more reliable.
Can you give a quick example? Which assets do the heavy lifting in each season?
Sure. So, roughly. Rising growth, you're looking at equities and maybe commodities to do well. Falling growth, that's when your long-term and intermediate bonds should kick in as rates usually fall. Rising inflation, gold and commodities are your main hedges there. Real assets. Falling inflation or deflation. Again, long-term and intermediate bonds should benefit as yields likely fall further. See, each one has its moment, balancing the whole thing out.
Got it. Now, you mentioned the institutional version uses capital-efficient portfolio engineering. What on earth does that mean, and how is it different from me just buying some ETFs?
Right, this is where the pro version gets fancy. They use instruments like futures contracts, swaps, other derivatives. This lets them get the exposure to an asset class like capture its performance without having to pie up the full amount of cash. Say, they can get long bond exposure using derivatives with much less capital than buying the actual bonds. It allows them to achieve that risk balance very efficiently, even using some leverage to put lower risk assets like bonds on a more equal risk footing with equities. And it can free up capital.
Okay, so for the average person just buying the ETFs,
Yeah.
that's an approximation then, because we can't easily access that complex leverage structure.
Precisely. I mean, the returns, the risk profile.
Yeah.
They won't be identical. You know, there's that ALLW ETF managed by Bridgewater that tries to replicate some of this, but it comes with a higher fee. So the simple DIY approach is really about applying the philosophy with the tools you have available.
Understood. And thinking about that trade-off, what's the main thing you give up by choosing this strategy? What's the opportunity cost here?
The big one is potential upside, especially during really strong, long-lasting stock market rallies. With only 30% in stocks, you're just not going to capture as much of that upside compared to someone with, say, 60% or more in equities.
Yeah.
One source put it nicely. The dampening of drama on the downside means a lack of fireworks on the upside.
It's a deliberate choice. Avoid the big crashes, even if it means missing some of the biggest booms. Steady wins the race kind of mentality.
Yeah. Exactly. Steady over speedy. And to make this whole thing work consistently over time, there's one more critical piece. Rebalancing discipline.
Right. Rebalancing. How often and why is it so vital here?
Dalio generally suggests at least once a year, or maybe sooner if one part of the portfolio drifts too far from its target weight, say 5% or 10% off. And the why is really important for a few reasons. First, it maintains your target risk profile. Markets move, assets perform differently. Your 40% bonds might become 45%. Your 30% stocks might become 25%. Rebalancing brings it back to the intended risk balance. Second, it forces you into a systematic buy low, sell high discipline. When stocks have soared, they're overweight. Rebalancing makes you sell some. When bonds have tanked, they're underweight. Rebalancing makes you buy more. It's countercyclical by design.
Buying what's down, selling what's up, without having to think too hard about it.
Exactly. And that leads to the third point. It acts as a crucial emotional guardrail. When markets are crashing, your gut screams, sell, get out. Rebalancing forces you to do the opposite, to buy more of the assets that are beaten down, potentially on sale. It takes the fear and greed out of it. It's like a behavioral finance tool built in.
That emotional point feels huge. It stops you from making panic decisions.
Absolutely. It's much easier to stick with the plan when the plan itself tells you exactly what to do when things get rough.
Okay, so the philosophy is compelling, the mechanics seem logical, but how did it actually do when things got really stressful? What's the real-world track record?
Right, the rubber meets the road,
Uh-huh.
and it's definitely faced some major tests. The big one everyone points to is the 2008 global financial crisis.
Yeah, that was a nightmare for most investors. How did the all-weather handle that meltdown?
Well, in 2008, it basically did what it was designed to do. Your typical 60-40 portfolio got hammered, down maybe 21%. The S&P 500 crushed, down almost 39%. But a theoretical all-weather portfolio was pretty much flat, a tiny loss, like a negative 0.4% theoretically. Even Bridgewater's actual fund, with its leverage, lost money, negative 20%, but still fared much better than the broad stock market. The long bonds were the heroes then. They soared as the Fed slashed rates, offsetting the stock losses. So 2008 was kind of its poster child moment for resilience. But fast forward to 2022, a very different kind of crisis. Yes, 2022 was a really tough test and very different. We had stubborn inflation and central banks jacking up interest rates super aggressively. This absolutely clobbered long-term bonds. The sources mentioned the main long bond ETF, TLT, was down something like 30%, a huge hit.
And the killer part was that the usual defense mechanism bonds zigging when stocks zag, that negative correlation just broke. They both went down hard, together.
Exactly. That's the nightmare scenario for this kind of strategy. When your two biggest pieces, the ones supposed to balance each other out, both fall sharply, your diversification benefit shrinks fast. And the result was the all-weather portfolio took a significant hit. Theoretical versions were down maybe 15-20%. Bridgewater's actual fund, reportedly down 22%. It really showed it's not, bulletproof.
Mm-hmm.
When core correlations fail, especially that stock bond one in a rising rate environment, it hurts.
So, looking beyond those specific crises, what about the longer-term performance picture?
Over the long haul, it generally delivers on that promise of a smoother ride. Lower volatility, smaller drawdowns compared to equity-heavy approaches. Since 2008, a simple ETF version has maybe compounded around 6% a year. That's a bit less than the 60-40 or the S&P 500 over that specific period, which included a massive bull run. Go back further, say 1973 to 2024. After inflation, it's returned about 4.6% annually. The S&P 500 did better, around 6.5% inflation adjusted. So you get stability, but yeah, you usually underperform stocks over long bull markets.
Which leads us neatly into the criticisms, what are seen as the main weaknesses. The strategy's Achilles heel, so to speak.
Yeah, there are definitely fair criticisms leveled against it. Number one, and most common, is that underperformance during strong stock bull markets. That low 30% equity slice means you just miss out on a lot of the upside when stocks are roaring. If the S&P 500 is your benchmark, you'll likely lag. Second, there's that heavy reliance on bonds and the associated interest rate risk. Look, the strategy benefited massively from the roughly 40-year bond bull market where rates were mostly falling. If we're now in a different world, maybe higher for longer rates, that 55% in bonds could be a real headwind. Rising rates mean falling bond prices.
Right, that tailwind could become a headwind.
Exactly. Third, as 2022 showed, that potential breakdown of the stock-bond correlation is a serious vulnerability. If they both fall together, a core defense is weakened. That challenges the handle-any-weather claim. And finally, some analysis suggests it might support a lower sustainable withdrawal rate for retirees during periods of really high persistent inflation, like the 60s or 70s, because bonds, while stable nominally, can lose a lot of purchasing power then.
So it sounds like the Achilles heel isn't one single flaw, but maybe how its core design, high bonds, low stocks, reliance on that negative correlation interacts with a fundamental change in the economic weather, particularly moving away from that decades-long disinflationary falling rate environment.
That sums it up really well. Its potential weaknesses become more apparent when the underlying economic regime shifts away from the conditions that provided major tailwinds for its structure, especially that long decline in interest rates.
Okay, so for most of us, the complex institutional version is out of reach. You mentioned the DIY approach with ETFs. How realistic is that for capturing the spirit of the all-weather? What does that look like practically?
It's definitely realistic for capturing the philosophy and the general shape of the allocation. A common way people approximate it using simple, low-cost ETFs involves these kinds of holdings.
Okay, walk us through a typical DIY recipe. What ETFs and percentages are we talking about?
Sure. Based on that popular blueprint, you might see something like 40% in a long-term U.S. Treasury bond ETF, maybe the iShares 20-plus year Treasury, simple TLT. 30% in a broad U.S. stock market ETF, could be the SPDR S&P 500, SPY, or Vanguard's Total Stock Market VTI. 15% in an intermediate-term U.S. Treasury ETF, like the iShares 7-10-year IEF or Vanguard's Intermediate-Term Treasury VGIT. 7.5% in a gold ETF. Popular ones are SPDR Gold Trust, GLD, or iShares Gold Trust, IAU, and the final 7.5% in a broad-based commodity ETF, maybe the Invesco DB Commodity Index, DBC, or their Optimum Yield 1, PDBC, which avoids the K1 tax form.
Got it. And what are the key things you don't get with this DIY version? What are the limitations compared to the Bridgewater mothership?
The main difference, like we touched on, is the lack of leverage and capital efficiency. You're buying the assets directly, dollar for dollar. You can't replicate the sophisticated risk balancing or potentially juice the risk-adjusted returns the way they can with derivatives. Also, your allocation is less dynamic. You set it, you rebalance maybe annually. Bridgewater's fund is actively managed, potentially making tactical shifts, and the diversification is likely simpler. You might miss out on global bonds, different types of commodities, or other alternative assets the big fund might use.
So really important to manage expectations. This DIY version is mimicking the idea, not the exact engine or results.
Exactly. It's about implementing the philosophy of all-weather preparedness and risk balance using accessible tools. That philosophy itself is valuable, but yeah, don't expect identical performance to the institutional fund.
Okay, pulling this all together, the thinking, the build, the performance ups and downs, the DIY option, who is this strategy really for? Who's a good fit? And who should probably look elsewhere?
Yeah, it's definitely not a one-size-fits-all. It's much more about matching the portfolio's characteristics to your specific needs, your timeline, and maybe most importantly, your gut reaction to market swings. It's likely a near-perfect fit for investors who are really risk-averse, people who prioritize not losing money over chasing big gains, who get stressed out by volatility. Great for those focused on wealth preservation rather than aggressive growth. Especially good for people nearing or in retirement. Why? Because its stability really helps manage that dreaded sequence of returns risk, the risk of big losses right when you start withdrawing money, which can wreck a retirement plan. And of course, institutional investors who can access the more complex leverage versions.
Makes sense. And who's probably not the target audience?
It's likely a poor choice for a few groups. Young investors with decades ahead of them. They can generally afford to take more risk for potentially higher long-term growth from equities. They have time to recover from downturns. Also, anyone with very high growth goals, or maybe someone with strong conviction in specific stocks or sectors who's comfortable with concentration and volatility. And definitely not for someone whose main goal is to consistently beat the market, meaning outperform the S&P 500 every year. That's just not what it's built to do. It's built for consistency through market cycles, not winning every single upswing.
It really hammers home that portfolio construction is personal, matching the tool to the job, and the job depends on you.
Absolutely. Your temperament, your goals, they matter hugely.
So let's say someone listens to all this and thinks, okay, maybe the full all-weather isn't quite right for me. Are there still valuable lessons here? What are the big takeaways from Dalio's approach that any investor could benefit from?
Oh, absolutely.
Yeah.
I think the underlying principles are incredibly valuable, maybe even more so than the specific allocation itself. Several things stand out. First, thinking about diversification across economic environments, not just mixing stocks and bonds. Asking, how will my portfolio do if inflation spikes or if growth stalls? That's powerful. Second, the whole idea of risk balancing, focusing on how much risk each holding contributes, not just how much money you put in. That leads to more robust portfolios. Third, that philosophy of preparation over prediction. Just acknowledging we don't know the future and building a portfolio that can handle a range of possibilities, that's a much more sustainable mindset than constantly trying to guess right.
Preparation, not prediction. Yeah.
Fourth, the simple value of staying invested. Assets generally outperform cash long term. A strategy designed to reduce scary drawdowns helps you stay in the market through thick and thin. And finally, the power of rebalancing discipline. It keeps your risk in check, forces you to buy low and sell high systematically, and importantly helps manage those destructive emotional reactions to market swings.
It really feels like Dalio's biggest contribution might be popularizing these deeper ways of thinking about risk, macro factors, and building resilience.
I tend to agree. He's pushed investors, especially sophisticated ones, to look beyond simple asset buckets and think about the underlying economic forces at play.
Well, this deep dive was built entirely from your sources. We've tried to pull out the core ideas, the philosophy, the mechanics, how it actually performed under stress, and what it means for you practically. We've really explored a strategy rooted in accepting that the future is fundamentally unknowable.
It definitely forces you to confront that uncertainty.
Which kind of leaves us all with a question to chew on, doesn't it? If one of the world's most successful investors builds his core strategy around the idea that he can't reliably predict the future, what does that imply for how you approach building your own financial resilience? Are you placing bets on guessing the next economic weather system? Or are you truly focused on preparing your portfolio for any storm that might blow in?
That's a great question to reflect on.
Thanks for joining us for this deep dive.